Hello everyone and welcome back to another video. Today I will be covering a product which a lot of investors really fail to fully understand. Even though the space is quite large, I believe that latest statistics show there are between 2.1 to 2.5 billion US dollars invested in leveraged ETFs or LETFs. And this is more of a trading vehicle than an actual investment vehicle. And unfortunately, once again, you'll see a lot of retail investors stepping in and purchasing and acquiring these trading vehicles, assuming that they can hold these for the long term. And eventually they wake up and they see that they're down 30% because fees have really eaten into their returns. So hopefully in this video, we can kind of cover a lot of the different kind of questions that people might have, starting with the rebalancing efforts of the actual product itself, going into the fees, longer term performance. So anything that you really it's more of an introductory analysis of this product. So let's get started. So what is a leveraged ETF? It is an exchange-traded fund that uses financial derivatives and debt to amplify the returns of an underlying index. On the surface, holding a 2x leveraged ETF is supposed to earn twice the daily return of the underlying index or composite. Unfortunately, many investors fail to truly understand and distinguish between unleveraged and leveraged ETF products. There has been major support shown in the financial media in favor of ETFs, but LETFs are different and much more riskier. And this is really important to understand. There's a big difference. ETFs, focus on diversification, focus on steady passive investing versus LETFs where, with LETFs, it's a trading vehicle that daily traders who it's their job to really kind of capture the daily performance of an underlying index and amplify their returns. But majority of them don't hold it overnight. They actually get in, hold it for a few hours, and then get out as fast as possible. Because, as we'll go later on, you'll see that there are a lot of downsides to using this product. Now, let's understand the basic leverage ETF. So how does a 2x leverage ETF work? Although most funds depend heavily on derivatives, we will begin with the simplest form of a leveraged ETF. So consider company A. Its current share price is $100 per share, and you want to build a 2x ETF to track its performance, a long 2x ETF. So the following are the 4 days of Company A's stock, starting at the 100 share price level on day 1. Then in day 2, the stock increases by 5% to 105. Day 3, it increases by 1.9%. In day 4, there's a down day, so it falls by 3.74%. And then day 5, it increases by 6.8%. So this is the stock that we're going to be referencing to throughout the following examples. So this is kind of, from a stock's perspective, would be your return if you were to hold one share of this respective stock. Okay, now let's first look at how a regular ETF would be organized to track Company A if $1 million was raised from investors. So before we go into a leveraged ETF, let's understand an ETF. Now, an ETF, as probably most of you know if you're interested in LETFs, is holding a bunch of stock, a basket of stocks that will represent the underlying index or the underlying composite that that it's trying to capture. In this case, if we're trying to track one company, it doesn't make sense to build an ETF for one company, but for simplicity's sake, let's build a basic ETF to track Company A. Okay, and so you've raised $1 million, and this is considered the assets under management, the AUM of the ETF. Now you use these funds to buy Company A's shares for $100 each on day 1 for a total of 10,000 shares, right? So $1 million, price, one share costs $100. That will get you 10,000 shares on day 1. So the ETF buys 10,000 shares on day 1, okay? Now, this side, we've already looked at. That's the performance from the stock's perspective. Now, the ETF's perspective, if we were to hold the $10,000 shares, is on this side of the graph, right, on the diagram, right? And so on day 1, you can start here, the date, day 1, shares held is 10,000, and it doesn't change throughout because we just used the $1 million, and we're assuming that we're not taking additional funds, right? And so for day 1, this company's stock price is $100 per share. There are 10,000 shares, so the total AUM is the initial AUM of $1 million, right? Then the next day, the stock's daily return, it increases to 105. So the 10,000 shares that we have multiplied by 105 equals 1.05 million AUM, right? And that returns 5%. And it goes on to the next one, which returns 1.9%. And then the next one, negative 3.74%. And this matches the stock's daily return. So it's fairly simple to understand how a basic ETF, an unleveraged ETF, would work by purchasing the composite of stocks that really track that index. You can then really just hold on to those shares, and as the share price of the each company changes, then the total AUM of that composite changes as well, tracking the net performance of that group of companies. So it's not very difficult to understand. Okay, now let's consider a LETF, a leveraged ETF, using debt to leverage its equity position. And so I want to make a comment before. Nowadays, and we'll go into a real world example, we'll actually look at an actual ETF that's traded in the market and go through its prospectus. But most ETFs now actually use financial derivatives instead of debt to really leverage themselves. But the concept is similar. So, and it's much easier to understand from a debt perspective how you create that leverage versus looking at forward contracts and pricing those forward contracts. So we'll stay with the debt through leverage, okay? So and it is the easiest form of leverage to understand. So consider a 2x company A long ETF with the same initial $1 million in starting AUM. As before, we have the performance of the stock, company's A stock. Nothing has changed. But you'll see that the blue numbers over here, these are the target 2x returns. This is what it should be. So on day 2, when this company stock returns 5%, 5 times 2 equals 10%. So the target daily performance of the LETF needs to return 10%. The next day, the stock increases by 1.905%. And so the 2x target is 3.81%. Right? And so on and so forth. So these are the targets. Okay, now we're going to add the ETFs perspective. So going over to this diagram, so you see this is the ETFs. Now, in order to achieve a leverage ratio of 2x, you need to take out an additional $1 million in debt in order to increase the return associated with investors' equity portion. So you buy an additional 10,000 shares. So that's fairly simple to understand. That's leverage. The basic concept of leverage is that you have your own equity, the money that you have, and then you take out and borrow money to increase and magnify your buying power, which allows you to own more shares, and then the associated return of the aggregate value of your holdings relative net to your equity portion of those holdings is significantly higher, and that's called leverage. That's how it works, okay? So now looking at the ETF's perspective, now with that additional $1 million, you can buy an additional 10,000 shares at a day one's price of $100 per share, correct? So that's not difficult to understand. So now we had the initial 10,000 shares that we bought with our equity. Now we have an additional 10,000 which we got with the money that we borrowed. So net we have 20,000 shares that we hold at the day one's price of 100. That means that total AUM is $2 million. Now breaking down that AUM, we have $1 million in debt, which doesn't change. We're not taking out any additional debt, nor are we buying any additional shares, right? But what changes is the equity portion, right? So as the total AUM increases, the portion of equity relative to the overall increase in total AUM increases as well. Right? And so that's the return that we're looking at. We're looking at that equity portion return. And so return on equity in day 2, right? So if so our initial equity of $1 million, then as the stock price increases to 105, 105 times 20,000 shares held is 2.1 million in AUM. You take away the 1 million in debt, and our equity portion is now 1.1 million. Right? And so the difference between starting day 1 and day 2 is a return of 10%, which matches our target return. Great. The next day, this company stock increases from 105 to 107. 107 times 20,000. Now the total AUM of the leveraged fund is 2.14 million. You take away the 1 million and you get an equity return of 1.14 million. Now, the difference between day 2 and day 3's equity portion returns 3.64%. That deviates away from the target return of 3.81%. Okay, so the fund actually returned below its daily target, so that was actually failing to. Then the next day we do the same thing, and so the daily target when the stock fell is negative 7.48% versus negative 7.02. So in this case, it didn't really fully capture the target fall that was needed, right? So what's actually happening here? Well, the ETF is actually failing to meet its 2x leverage target after day 2. Why is that? Because this is very important. Well, let's recall the formula for leverage. So once again, total leverage equals the total assets under management, or for a business, is the total assets that that business owns, divided by the equity portion of that business, or in this case, total equity, which is the invested equity of investors, right? So our total AUM in the basic unleveraged ETF, total AUM was $1 million, and the invested capital of investors was $1 million. So total leverage was 1. It was a basic ETF. Now for the leveraged fund, the 2X fund, total AUM starting was $2 million, and then total equity AUM from investors was 1 million. So total leverage was 2. Okay. The thing is, the AUM level changes, which changes the overall leverage of the ETF. So you'll see that the numerator of this quotient, the total AUM, so the top level of the quotient, changes, right? We're not taking on any additional equity. Like investors have put that $1 million in, and that's it. But for AUM, it changes significantly, right? And so as AUM changes, the overall, like total assets divided by total equity equals a leverage ratio, right? And so as AUM changes, then the leverage ratio changes as well, unless we rebalance and we keep up with that. So that's really important. So with the numerator changing in value, the leverage ratio will change on a daily basis. Very important. This is the most important thing. Therefore, you need to rebalance the fund to achieve that target. There is an inverse relationship between the stock price and leverage. So as the stock price increases, leverage falls. So all we've done here is we're now calculating the leverage ratio in this scenario. So we're looking at the ETF's perspective, and now we're calculating leverage. So on day 2, with AUM of 2.1 million and equity of 1.1, the leverage ratio was actually 1.91 that day. In day 3, as AUM continued to increase, the leverage ratio fell even further. As AUM fell, as the stock underperformed, leverage actually increased, right? It went from 1.88 to 1.94. But then once again in day 5, the stock increased in value, and so leverage fell. It fell to 1.83. And so this is so important to understand. You can't create a leverage ETF yourself. These are what the products do. The products, in themselves, it offers a constant daily rebalancing effort by the fund administrator, which offers that consistent leverage. So if they have a fixed target of 2x and they've promised the investors that yes, we will always maintain a 2x daily performance, then they have to rebalance on a daily basis because AUM changed. Okay? So how do we rebalance the fund? Assuming that equity funds are fixed, assuming that no added investor money is entering. Well, the source of any increase or decrease leverage ratio must come from the debt portion of the fund. So let's now consider how debt needs to change in order for the leverage ratio to stay the same at 2x, okay? So not too complicated. Essentially what this means is that if AUM, which we can't control because that's related to, again, the performance of the stock and the number of shares that we hold, and equity stays the same because, no new investors are investing in the fund, then the only segment of, net AUM that can change is the debt. And that's what the fund administrator has control over. They can decide to take on more or less debt. And so that's what they control. So now let's look at that. So recall once again the total leverage formula. So we have total AUM, total assets divided by total equity. And so now let's take day 2, for example, where AUM is 2.1 million. How much debt in that scenario do we need in order to maintain the 2x leverage ratio, right? So going back to this example over here, on day 2, just without any changes in debt, the leverage was 1.91. So how do we increase leverage to maintain it at the 2 promised level, right? How do we do that? Well, looking at the leverage formula, we can actually expand the denominator in this formula. So replacing total equity is a function of the difference between total assets minus total debt, right? So we can replace total equity with total AUM minus total debt. So the total leverage ratio becomes total AUM divided by total AUM minus total debt. And in this scenario, we can then really manipulate the formula, right? We now know the variables. We know the leverage, our target leverage is 2, and we have AUM of 2.1 million, 2.1 million, 2.1 million, and we need X, which in this case is total debt. So all we have to do is isolate, move around the formula a little bit, and isolate for total debt on the left-hand side of the formula and get our answer, right? And so I won't do that in this video, but essentially it gets down to about 1.05 million. So that's the total debt level that's needed on day 2 in order to maintain the leverage of 2. So the formula, the general formula to calculate the new level for the new debt level for rebalance is total debt equals total AUM minus total AUM divided by the target leverage. Okay, so in our example, in the day 2, it'd be total AUM of 2.1 million minus total 2.1 million divided by 2, right? And that will give us our total debt necessary to maintain that leverage ratio. Okay, so now I've kind of put this into Excel. I put that formula in, and now I can calculate the actual debt that's needed. So what happens is that when you take out the additional debt, it is added to AUM, which can increase it further. So, okay, I don't want you to feel nervous, but let's start off once again. Day 1, we know this. We know that day 1 we took out 1 million in equity, and then we took out debt of $1 million. Now our equity, there are no new equity additions except for the increase in the value of equity. And with debt, on the first day, we say that, okay, we're taking out debt. Now the stock price increases, so total AUM is 2.1 million, equity is 1.1 million. Now how much debt do we need to maintain that target leverage ratio? We did this in the previous slide. We calculated 1.05 million. Okay, now the third day. Going on to the third day, once again the stock increases, and the total AUM is now valued at 2.231 million, right? And so the equity portion of that is 1.14 million. Now, how much debt do we need? Well, we can go back to this formula and we can put that in there. So we can take this AUM number over here, right? The AUM, put it in over here, minus, once again, the AUM, and divide it by 2. And that will give us total debt of 1.115 million, right? And so that keeps our leverage target at 2. And what you can see, actually in the next slide, yes. So in the next slide, essentially what I've done is I've just isolated for the changes in the debt level from day to day. So here, to display the rebalance efforts of the exercise, let's show the change in debt levels and how many shares are bought using the new debt in each period. So in day 1, we're not adding any new debt. We have our starting debt. In day 2, we're adding $50,000 in debt to buy 476 shares. In day 3, once again, the stock price increases, so we need to increase our leverage back to 2, right? So our debt level changes by $65,000. And that's about 616 shares. Now in day 4, once again, that's when the stock price fell. In day 4, we're actually paying back some debt. We're paying back about $72,000 in debt by selling 702 shares. Right? And so this is the daily rebalancing efforts. And as you can see, if you're taking out debt every single day, and at the same time you're buying and selling shares every single day, that adds up to transaction costs. And that's really the big killer in LETFs. The transaction costs on top of the management fees make this product incredibly costly. And so we'll actually go into that a little further. So yeah, okay, so that was essentially the example. Now let's talk about the clear tracking error over the long term. From a daily performance standpoint, leveraged ETFs do a relatively good job of meeting their leverage targets. However, over the long term, it becomes incredibly difficult due to the compounding effects. So in the short term, the constant change in debt levels, selling and buying shares, you can kind of really track the daily return of that index. But over the long term, when you're talking about compounding effects, remember, if a stock increases by 3% and then falls by 2% and increases by 4%, right, that the principle changes. Right? You can track the percentage terms, but overall, the actual dollar terms of that index, the performance of that is different, and so that it increases in kind of deviation over the long term. So here's an example of the SSO. It's a leveraged ETF, so the 1-year Ultra S&P ETF. Right, relative to the S&P index, right? So as of June 2017, the ETF returned 35.21% relative to the underlying index, the S&P 500, which returned 15.76%. Now, if you were to really focus on the target level, well, you would multiply 15.76% times 2, and that answer would be what the ETF should have returned in that 1 year. But what happens is there's actually a deviation of 3.69%. So the leverage ETF returned an additional 3.69% above what its target should be. And so only in 1 year already. Right? Well, let's look now at a 5-year chart. So the 5-year, the same index, so the same LETF and the same underlying index, the ETF returned 276.29%, thankfully enough because we're in a bull market, relative to the S&P 500 index, which returned only 90.7%. Now, multiplying that by 2, you actually see that the deviation is 94.89%. So above its target level of what it should be about 81%, it returned an additional 94.89%. So over the long term, and again, like that's great in this scenario, but in volatile markets, that means that over the longer term, you're not achieving the target of what it should be, right? Because once again, of compounding effects. And once again, we're very thankfully enough, between the post the financial crisis, the US market has been very bullish and we've been in a great long bull market. But in volatile markets, especially when things become really uncertain over a 1 to 2 year period, holding on to an LETF will really kill you, not only from a fee perspective, but from a return perspective, because there is a clear tracking error over the longer term. Okay? Now, talking about the volatility drag. This is probably the most confusing topic discussed when covering leveraged ETFs. The volatility drag, essentially what it means is that over time, if an equity or ETF experiences a lot of volatility, it becomes more and more difficult to earn a higher returns because the price needs to make up for the downswings during the upswings. Okay, what does that mean? Because right away, I remember when I was first learning this, I'm like, what? What does that mean? Well, with leveraged ETFs, volatility is increased, and this increases the impact of this respective drag. The better way to look at it is that the volatility drag is defined as the difference between the arithmetic returns and the geometric returns of that respective stock or underlying index. With higher volatility drag, the difference between the arithmetic and geometric average will be larger. So consider the following example. Don't worry if you don't understand anything yet. We'll go through the example and then I'll really cover it in depth, okay? So let's look at a regular stock. Here I went by year. So year 1, the stock price is $10. In year 2, it increases to $10.27. And year 3 and so on up until 20 years, right? And so here you have the yearly returns. And so this is regular stock. There's a little bit slight deviation. You have a big uptrend of 3.9% in year 7, and then you have a decline of 2.02 in year 4. So I wouldn't say it's an incredibly volatile stock. Now I've created a hypothetical 3x leveraged ETF of this respective stock. Essentially what that means is that you multiply this yearly return by 3, right? And then you calculate the stock's performance and so on and so forth, right? So this essentially is, yearly return is times 3, 2.70, right? So 3 times 2.7% is 8.10%, right? And essentially this stock, the leveraged ETF of the stock, is incredibly much more volatile than the regular stock itself, the underlying asset. Now, going back to this example, so with the volatility drag, it's the difference between the arithmetic and geometric average, right? And I've actually made a video on that, so if you don't know what those are, you should probably go and watch that video first. But essentially the arithmetic, when you calculate the average, usually what you calculate is, you sum up the values and then divide by the number of values. That's the arithmetic average. And then the geometric average is the compound annual growth rate of whatever, equity you're looking at. So that's kind of quick overview, right? So I've calculated those averages, right? So the arithmetic average for the regular stock is 0.52%, and the geometric average is 0.48%. For a difference, so 0.52% minus 0.48% of 0.03%. Now, the 3x leveraged ETF of the stock, the arithmetic average return was 1.55%, and the geometric average return, or the compound annual growth rate of the leverage ETF of the stock, is 1.40. Now, the difference between those is 0.15%. So there's a clear difference in the differences, right? So as you can see, the 3x leverage product, the difference is 5 times larger. So why does this matter? Well, say for example, you buy a $1 stock and the next day it jumps up to 10%. The price is now $1.1 a share. That's great, right? You want to cash out, but you tell yourself that maybe tomorrow it will happen again, right? So you look at that return and you look at, $1.1 a share and you're like, wow, like that's very high for this stock. I really think that, it's not going to go above this. I kind of want to cash out, but maybe one more day. So you wait. But then the second day, the stock falls by 10%. So it increased by 10% and then it fell by 10%. But by falling to 10%, now it falls back to $0.99 a share, right? So to get back to the same level of $1.1 a share, the stock now needs to increase, now needs to return 11.11%. Even though from a percentage perspective, the stock increased by 10% and then fell by 10%. That 1.11% return needed to get back to the same level is the volatility drag. So that's really important. So say, for example, you're looking at an underlying index and you're saying that, oil is at $100 a barrel, right? Now, from a percentage perspective, if the 3x leverage product for oil increases by 10% and then decreases by 15 and then increases by 15, you'll see that it's really hard to get back to that underlying $100 barrel level. And the overall net returns erode away, and that's because of the volatility drag. So that's really important to understand. And once again, another negative side of the leverage ETF over the long term. That's why, once again, you don't really hold on to this. If you see that your leverage ETF has returned 15% in one day, cash out, get out fast. Because if tomorrow it falls by 10%, to get back to the initial level of yesterday's price, it's going to take a lot more time, or it might not even get there anymore. So that's really important. Okay, so now let's look at a real world example. So being based in Canada, I took a Canadian leverage ETF, and this is the Horizons Beta Pro S&P TSX Capped Energy Bull ETF. This is offered by Horizons ETFs. It's a provider, and the ticker symbol is HEU. So here's a Morningstar screenshot of this leverage ETF. It's priced as of Friday, June the 2nd, 2017 at 9:04, right? This is kind of like the return because it's an energy leverage ETF over the past few years, the past 2.5 years. Oil has collapsed, and so it has underperformed significantly. It has total assets of 13.87 million Canadian dollars. It has a management expense ratio, an important stat, of 1.52%. So that's the expense of just covering, the administrative costs. Has an opening price of 9.26, a range between 8.92 and 9.26, a 52-week range of 8.92 and 14.52. So you can see that it has fallen significantly. But long story short, this is just a regular leveraged ETF, a real-world example. Okay. Now, the following is found in the fund's prospectus. So for this video, last night, I stood up for about an hour and a half, and I read the entire product's perspective. Okay, so let the legal mumbo jumbo begin. So I took some experts that are really going to communicate to you the complexities of the product, but at the same time help you understand what you're actually buying. Okay, so let's get started. There's a lot of words on the slide, so please forgive me. So number one. So let's read this. The ETFs are very different from most other exchange-traded funds. The double ETFs use leverage and are riskier than funds that do not. The double ETFs do not and should not be expected to return 2 times 200% or 2 times the inverse as applicable. The return of the underlying index over any period of time other than daily. So essentially what that means is that legally they're not selling you a product that's going to return 2 times over a 20-day period. They are only aiming for the 2x return on a daily basis. And so we talk about the tracking error. That's really what it is. They acknowledge that. They're acknowledging that at the end of the day, this leverage ETF is not going to return 2x over the long term. Especially in a volatile market, that can mean a lot of bad things for you because you'll probably end up in a losing position. The inverse ETFs do not and should not be expected to return the inverse of the return of their underlying index over any period of time other than daily. The returns of the ETFs over periods longer than 1 day will likely differ in amount and possibly direction from the performance of their underlying index for the same period. This effect becomes more pronounced as the volatility of the underlying index increases. Investors should monitor their investment in an ETF daily, right? So essentially, they're saying that over a more than one day period, the ETF, the leverage ETF, might not even return a positive return if the underlying index returned a positive return, right? It might deviate from the actual performance, possibly the direction of the performance of the underlying index. So once again, they're telling you it. They're hiding it in the prospectus, and a lot of people don't read it. But once again, if you're buying this product, read the prospectus. I'll actually attach a link to this respective prospectus where you can kind of read through the exact same PDF document. Okay, let's go here. Now, each double ETF employs absolute leverage that generally does not exceed 2.0 times the net asset value of that ETF. So we already talked about this before, but let's look at this again. So this means that if the net asset value of the fund is $10 million, so in our example, the AUM was $1 million, right? But if, say, for example, the net asset value is 10 million, the combined exposure through derivative instruments, debt, and equity generally does not exceed, and the key word is generally, because in extreme scenarios it always will, but generally it will not exceed 2 times that, which in this case would be 20 million. So what does that mean? Well, why is that important? Well, essentially, if you're looking at, let's actually look at this fund itself. So the total assets of this fund, 13.87, right? Can I pull up a calculator here? Right, so 13.87 times 2 generally should not exceed 27.74 million in AUM, right? So that's essentially what it's trying to tell you. Now, another excerpt. So each ETF, other than the US ETF, is rebalanced every day on which a session of the TSX is open. Each US ETF is rebalanced on each day that the TSX and the New York Stock Exchange are both open, and provided it is not a bank holiday. So talking about those rebalancing efforts, what happens is that it is rebalanced every day. So the market closes, the next day the market opens. So in our example, actually this is good. I'm going to go back. Sorry, we're jumping between slides, but it's really important to understand. So going over here, this is our leverage, right? So essentially, this, say for example, a leverage ETF starts off on day 1. It's a brand new, it has the existing leverage of 2. The next day, at the start of day 2, they rebalance. They don't rebalance at the end of the day because then they won't meet their target performance. So they rebalance in the morning, right? So that's essentially, if you buy a LETF in the middle of the day, the next morning is when they rebalance. And that means that you're going to be charged transaction costs, you might be charged borrowing costs, forward contract costs, all that, which we'll talk about later. Okay? So that's really important to understand. Oh my God, jumping between slides. Okay. So for anyone wondering, when the rebalancing occurs, it occurs at the start of the day. So what about forward contracts? Because a lot of products, they don't actually use debt, but rather forward contracts. Well, each of the ETFs has entered into multiple forward documents with a counterparty or counterparties. The ETF have entered into forward documents that will provide positive exposure to its underlying index, and or forward documents that will provide negative exposure to its underlying index. Each ETF seeks to achieve its investment objective through the net exposure of its respective forward documents. So that means that it might actually invest, say for example, it's a long fund, it might actually take short positions in that underlying index just to hedge, right? But the big one is that each ETF is entitled to pre-settle with the forward documents in whole or in part from time to time as needed to fund unit redemptions and market repurchases of units, pay administrative expenses, meet other liquidity needs, and such other purposes as an ETF may determine. So they need to pre-settle those forward documents. So they might actually be using your money to cover their forward documents and not actually invest in the fund itself. So this is really important when the markets go to shit, and like the market is incredibly volatile, and especially if there is significant counterparty risk, which means that the guy on the other end of the forward contract, fails, he goes bankrupt. What happens is at the end of the day, they're going to be using your money to cover their ass first. And that is a huge concern, especially when you're betting on a leveraged product like this. Okay, so once again, that's very important. Now, what about the offering? So units of each ETF are offered for sale on a continuous basis by this prospectus, and there is no minimum or maximum number of units of an ETF that may be issued. The units of each ETF shall be offered for sale at a price equal to the net asset value of such units. next determined following the receipt of a subscription order. And so essentially in the example that we were going through, I talked about how equity's fixed, how it's closed off. In the real world and with this product, what happens is it's actually open. So when AUM changes, there will also be an incremental change in equity. But at the same time, our example doesn't change much. Maybe the leverage ratio will not change by as much, but there'll still need to be rebalancing efforts in order to meet that difference and in order to push up that leverage back to its target level of 2 or 3x. Okay? Now, for income tax considerations, a unit holder of an ETF who is resident in Canada, this is based in Canada, will generally be required to include, in computing income for a taxation year, the amount of income, including such income that is reinvested in additional units of the ETF or paid in units of the ETF. So essentially, that means it's relatively similar to the taxation purposes, are relatively similar to other investments, except that, when you reinvest into a leveraged ETF, you're charged a little more. Not too much. I would say that because the cases go from case to case. So the best thing to do is, if you are interested in investing in an LETF, please talk to a financial advisor. Please talk to your financial advisor, or if you have one, shake that guy and tell him, don't invest in LETFs. Like, I don't need that. Just put me in blue chips. Like, it's not necessary. It's just not. But again, if you don't understand how it's relevant to your income tax kind of situation, you should be talking with a professional about that. Okay? So now, probably the big topic is the summary of fees and expenses for this respective product. So for this respective product, there are 5 types of charges. Okay, there's the management fee, there's the operating expenses, there's the forward document expenses, the expenses of the issue, and the redemption charge. And so I've taken this from the document itself, so the Horizons HEU. Being that the energy market has performed shit in the past few years, the annualized return was negative 49.69%, so you lost half of your money. And on top of that, you had a management expense ratio of 1.51%, plus a trading expense ratio of 0.67%. So you're actually paying more for this leveraged ETF than you would for an actively managed mutual fund, probably a top performing one as well. So once again, this is one of the big knocks against LETFs. The costs are significant. And so let's actually define these costs. I'm kind of going long in this video, but it's very important, especially if you're investing. So watch till the end. So the management fee. So each ETF pays an annual management fee to the manager equal to 1.15% of the net asset value of the ETF. Together with applicable sales tax, the management fee is calculated and accrued daily and payable monthly. So payable monthly. Okay? So that 1.15%, that's kind of like ETFs nowadays. Like, they cite one of the big advantages of ETFs is they're very cheap, right? You don't need active management, right? But the thing is, with LETFs, the costs are significantly higher, and they're actually comparable to some active mutual funds. Okay. In addition, there's the operating expenses. So each ETF will pay all of its operating expenses, including but not limited to management fees, audit fees, trustee and custodial expenses, valuation, blah blah blah, all that kind of stuff. So any fees that are really seen in the operations of this of the ETF itself, that is covered and represented in the ETF, and that's similar to mutual funds and other investment vehicles. That's represented in the MER, the management expense ratio percentage that's shown there, right? The big one is the forward documents expenses. So this is where you rack up those transaction fees. So the value of the forward price payable to an ETF under its forward documents is reduced by an amount equal to 0.35% per year. And I'll kind of skip the words here, but the next one, and this is the big one, hedging costs incurred by a counterparty are similar in nature to portfolio transaction costs that are incurred by an investment fund that holds portfolio securities directly. Currently, the manager anticipates that based on existing market conditions, so June 2017, the hedging costs, if any, incurred by a counterparty are between 0 and 0.65% per year of the aggregate notional exposure of the ETF's forward documents. So if they have, if the fund itself has $10 million in AUM and they hold $3 million in forward contracts, then on top of the additional management fee and on top of the additional transaction fees and entering and exiting positions, you will also see a between 0 on a really good market, and 0.65% fee charged on those, $3 million in forward contracts. So much more fees. There are a bunch of fees. Again, I think there needs to be a lot of change in regulation to really kind of inform people about these additional fees, because they'll end up really overpaying for the product. There are also expenses of the issue, which, apart from the initial organizational cost of the ETFs, all expenses related to the issuance of units are borne by the ETFs. And there's a redemption charge, which the manager may charge unit holders of an ETF at its discretion a redemption charge of up to 0.25% of the redemption proceeds of the ETF. So say, for example, we want to exit this ETF and they decide that it's a really bad time, like if you exit your position, they might actually be forced to put into a position where they have to sell a lot of assets that may hurt the fund itself. They can actually charge a redemption charge to kind of avoid you actually exiting your position. But majority of the time, people ignore that and just try to get out, right? Because they're selling and they're trying to get out of that bearish market. Anyways, once again, we have the same kind of capture as before. So we have the analyzed returns. So now we kind of fully understand this. So the management expense ratio, you have the redemption charge, expenses of the issue, you have the management fee and the operating expenses, and then your trading expense ratio. Essentially, here's the definition: means trading expense ratio represents total commissions and portfolio transaction costs expressed as an analyzed percentage of the daily average net asset value. So those are all the transaction costs that exist, especially in a leverage ETF where they have to rebalance on a daily basis. So those add up as well, right? And so that sums up to about 2.18%, right? And that, compared to a lot of mutual funds, is significantly more expensive. So this is, once again, a trading vehicle. It is not a long-term investment because fees will eat up your returns for sure. Okay, here's the fact sheet for this, just to show you an example. The asset mix for this, as of December 8th, 2016, they actually held cash of 74.7% and forward contracts of 23.9%. So they held no debt. And as I said before, now a lot of LETFs only are exposed to forward and more derivative options rather than actual debt. But in this example, you see that due to the energy market being in a bearish state, they actually hold a lot more cash than forward agreements. So it doesn't even make sense to hold on to this product at this moment, because you're actually only putting the fund provider itself is only putting actually 1/4 of your money into this leverage space. So it just doesn't make sense. But once again, that's just a fun fact sheet. I'll provide the links in the video description for you to kind of look up this product, but you can do this for any product that you're interested in looking at. So all that information is legally required to be provided by the provider itself. Okay, so a quick final risk overview. There are 4 key risks that should be considered when investing in leveraged ETFs. Be wary of holding overnight, so they rebalance the next morning, and so that can hurt you. Be aware of derivative risks. So in a very, very topsy-turvy market or in a bad market, the counterparty gets paid back first, right? And so that means that if there's counterparty risk, if either the provider itself, you're the fund provider, defaults, or the counterparty defaults, there can be some significant risk to that. In addition, active traders can pursue a leverage ETF rather than borrowing, rather than long-term investors who you're not interested in leveraging yourself. You're interested in capital preservation and focusing on long-term growth, right? So this shouldn't be something in your really investment options, right? And number 4, keep an eye on costs. The MER plus the trading costs can really add up and eat away at your returns. And you'll find at the end of the day that a underlying index, and I hear all these stories all the time, especially in the news, how this MBA student buys like this leverage ETF for the oil industry. The oil industry returns maybe 60%. The underlying composite, it returns like 60%, and their leverage ETF return them 13%, or even an actual negative return. So that's really important to understand. Once again, the best thing to do is to go speak to a financial advisor, go speak to the fund provider. They won't be so open, but if you push on them and you ask them about the way it works and how the LETF charges these fees, they will have to answer these questions, and that will help you better understand if this product is right for you. If you have any questions, please do reach out. Please comment below, and I'll be happy to answer as much as I know. As well, if you like this video, please like and subscribe to the channel. I love making these videos, and I hope I helped someone, because this is, once again, one of those spaces that is very much undercovered. Have a great day, guys.